But let's understand how bad this really is. Is this going to be like the recession around the 2008 time frame, or are we going to see the stock market take a huge loss like we did in 2020? Hello everyone, welcome back to my channel. My name is Skye Burch and I discuss budgeting, wealth building, and give you practical tips to help you progress and move forward in your life. Today we're going to be talking about, are we in a recession? And if we're not, when is it going to happen? And how bad is it really going to be? I have some updates from some of the top economists in the US that suggest that yes, we're going into a recession, but the recession is actually going to be mild. And in fact, they're calling it a stagflation. And yes, I know that the Fed announced a rate increase of 0.75%, which increases the cost of borrowing for everyone, and that it's the first time that something like this has happened since 1994 where they've increased the rate that much. But let's understand how bad this really is. Is this going to be like the recession around the 2008 time frame, or are we going to see the stock market take a huge loss like we did in 2020? Well, investors are expecting that the Fed will increase rates at the high end of its range to 3.75% by the end of the year. Okay, well, what does that mean? Well, for context, the Fed increased interest rates to 2.37% during the rate hike in 2018. And before the Great Recession, starting in 2007, the Fed increased rates to 5.25%. So 3.75 is higher than the rate hike in 2018, but it's not as high as the rate hike during the Great Recession. Now, this is just a tiny indicator to the probable cause of a mild recession during the end of 2022. But let's not just look at those things. Let's look at some other things to tell the true story about what's really going on. And by the way, if you're finding this information valuable, go ahead and give me a like so that this video can spread to more people. Thank you. So to tell the true story, we have to see what is the leading indicator of a recession and see if this situation fits within that leading indicator. And the indicator is that a recession is actually 2 consecutive quarters of a shrinking economy. And if you remember this from school, we use GDP numbers to determine if the economy is shrinking or growing. So what happened in the first quarter? Well, the economy actually shrank by 1.5% in growth. Well, what about the second quarter? Well, the GDP model suggests that there's going to be 0% growth in the second quarter, which pretty much is one step away from turning negative. So wait, 2 quarters of shrinking growth is said to be the definition of a recession. So how is this not proof that we're going to be in a wild recession? Well, although 2 consecutive quarters of shrinking growth is usually the definition of a recession, that is not always the case. For example, in 2001, the economy shrunk 2 quarters, but just not in a row, and that was declared as a recession by the National Bureau of Economic Research. Also, the Bureau of Economic Research declared a recession in 2020, even though the contraction only lasted for a couple of months. It's also possible that the economy could shrink for 2 quarters in a row and not be classified as a recession because the Bureau of Economic Research defines a recession as a significant decline in economic activity over the economy that lasts for more than just a few months. So it was the depth and how long the economic downturn lasted that led the Bureau to declare a recession in 2020, but it could also be the reason that they don't declare a recession in 2022, even with 2 consecutive quarters of falling GDP. And next release date for the GDP numbers actually falls on June 29th at 8:30 a.m. So we know it takes more than 2 consecutive quarters of falling growth to be declared a recession. And if you were thinking that the job market could be a leading indicator to a recession, then you're actually on the right track. So here's what's interesting. The chief economist from a top-tier equity research shared that the job market will be one of the main things to watch to determine if a recession is actually declared. And in fact, there has never been a business cycle where unemployment increased by 0.5 percentage points from 12 months prior without the US already being in a recession or on the cusp of one. Okay, so what's going on with unemployment? Has it increased by 0.5 percentage points? Well, the unemployment rate was 3.6 in May of 22, which is actually down from 5.8, which is what it was in May of 2021. So that doesn't come close to hitting the levels that would imply a recession is about to start. Not to mention that gains from consumer spending, housing, and private sector investment added 3.2% to growth in the first quarter, which is up from their 2.4 contributions in 2021. Ultimately, the most important aspects of the domestic economy showed better results in the first quarter of this year than it did at the end of 2021 when the economy was soaring. You see, we will likely go into a recession, but the impact will be mild. Economists have long expected slow growth or even a little bit of contraction so that the economy could cool off from such high levels of growth. And you may be thinking, well, look at the stock market. People's investments are clearly going down. And yes, the S&P went down 22% from its all-time high, the Dow Jones 18% from its record high. But this may or may not be an indicator of a recession because we have bear markets inside of a recession and we also have them outside of a recession. And in fact, the Conference Board economic forecast of the U.S. economy looking towards 2023 is actually not saying that we're going into a recession. They're actually calling it a stagflation. And a stagflation is a period of low growth and high inflation. And with this low growth and high inflation, there are discussions at the White House to talk about assistance that will help lower gas prices and the price of food. For instance, there have been talks about pausing the gas tax and issuing gas rebate cards to Americans. Also, our energy secretary will be holding a meeting with the top executives from 7 oil refining companies to talk about ways to lower gas prices. Of course, these are all discussions and nothing is guaranteed, so we have to take steps on our own to prepare for not some big, huge, wild, scary recession, but for what economists are saying would be a mild recession with low growth and high inflation. And even though it's expected to be a mild recession, we still need to take some steps to make sure that we aren't in a bind next year. Here's some things that we can do. Pay down debt. With interest rates being higher, you don't want that to eat away at your income. So you want to pay down your debt as soon as you can. Also, increase your savings. You want to aim to have about 3 to 6 months of expenses in your savings account. And this is just going to release the pressure that you may be feeling, knowing that you have something saved up in case something happens that you can go to. No one wants to have to sell stock when the market is down or borrow when interest rates are high. You want to be able to go into your savings account at this time. So continue to add money into your savings account. Next, cut back on expenses. Essentially, live below your means as prices are expected to remain high in the near future. And when it comes to investing, do not stop investing. Focus on long-term investing and diversify. Many investors panic when the market starts to dip and they sell their investments based on emotion. This is essentially what some investors did at the start of COVID-19, and they sold their retirement funds worrying about the recession. Experienced investors know, just stick with it. Yes, the market dropped drastically during COVID, but it improved by the summer. Many professionals advise just stay the course because many times large drops in the market are followed by even larger gains. And if you sell, then a lot of times you can miss out on that upside. Plus, staying the course would allow you to get free money through your 401k through your employer match, which you would be missing out on if you stopped contributing. All right, last 2 things. Of the 2, increase your skills and your training so that you can have a leg up in this competitive market. If unemployment rises, at least you will be adding value to the company that you're working for because you have refreshed and increased your skills to either get a promotion or look for a job that's paying a higher salary. And ultimately, the higher salary or the promotion can further boost your savings, which provides a safety net for you even more in this economy. And the last thing is continue to be a giver. I believe that giving not only helps you to have discipline, but it shows God how faithful you are with the amount that He has given you, and I believe that He will bless you with more. So continue to give, and I believe that the blessings will continue to come and more as you do so. And no, you don't have to give to receive blessings, but I believe that when you give, it takes you to the next level of what God has for you. And remember, there is still hope for the future, and we have the power to prepare ourselves by taking some of those steps that I mentioned earlier. And if you need some motivation for how to take steps to map out your life in general, take a look at my video, How to Get What You Want in Life. And until next time, thank you for watching, and we're gonna be all right, and I'll see you in another video.